S&P closes above 4,600. Nasdaq closes at a 2-year weekly high. Russell 2000 rockets 3% in a day as the 10-year Treasury cracks the 4.25 level. Over 100 basis points in cuts are predicted by December of next year. JP Morgan explains the comparison of Cisco to NVDA. The S&P EPS yield gap versus real 10-year yield is collapsing. We'll explain why. The Financial Conditions Index hits its lowest level in almost 50 years. Hedge funds in the same names is at the highest level in over 20 years. We'll explain what this means and how to take advantage of it. We have a ton to go over. Let's get to it. Hey, everybody, welcome back. Well, Wild Week finally comes to an ending, and we get that 4,600 we were talking about. A couple key things happened today. Let's start with the technicals. Number one, we are into the last month of the year, so the tax selling and the tax ramifications we always want to pay attention to, but this 4,600, our level right here, we're going to draw that in a moment. I think it's fascinating how this RSI got to 70 and then started to turn up. And sometimes this can happen. Now, before we go further, we have to break out the stool. We have to talk about the macro picture and what's going on here and why interest rates look like they're going to plummet. We also have to talk about what's going on overseas in interest rates. We won't spend a ton of time on it, but it's important that you understand this. You need to understand how the fundamentals are changing and why the technicals look the way that they do. So it was time to break out the stool. We have to focus on the macro. The macro is driving these. And there is a massive, massive shift going on in the financial conditions globally. But specifically, you have the strongest financial condition change that you've had in about 40 years. And we're going to dig into it. But before we get there, we talked about this. We talked about this 4,600. We went over the RSI in great detail right here. And you can see how we're getting over. This is exactly what you wanted. Now you're heading right back to this high. We're going to have to see how we act next week. What I like about it more than anything is the rotation. The rotation is key. Now, here's the weekly. Here's the higher high. Here's your reversal pattern right off of that in the beginning of November, how we rallied, got right to the top and flipped. And now it looks like we'd be heading right for this next level. Whether or not we get up there or not in a short period of time is anyone's guess, but that's 46.34. You'll all remember we wrestled with that. We did talk about this in great detail, how this was a cup and this was a handle. You always want to clone these and just see where they fit and how they come over, and that's pretty clear. And now we're just looking for that 46, and I have that at 46.34. So we have to drop that down just a little bit and put that right there. We have that as a weekly cup and handle, but where do you see this? That is a monthly chart of the S&P. It's almost like a picture. It's so perfect. The rally, the pullback. If this was a stock and you were looking at it this way, you'd go, oh, we just pulled back a little bit and we're going to rally. Let's clean it all off now. I mean, it's absolutely silly how perfect that looks. Look, up 1, 2, 3 down, and then the reversal. For those that are in the community, you know this pattern very, very well. You should. These rising 3, falling 3s historically are the highest probability candlestick patterns out there. That's not by me. That's in several candlestick books. I'm actually going to put a video together on candlestick books so that people can know which ones they should be paying attention to. If you have other lists of books that you're interested in, comment below and I'll put together some like options is what I was thinking, a list of day trading books, things like that. Actually really good books, not the books that the guy on TikTok wrote. So I think that it's important for people to start reading a lot of how this stuff really works candidly. So we're setting up here and we're setting up to really push. You can see your reversal up here, that bearish engulfing, and that really set us off on a technical level. We all know that there's more to it than that. Let's just mark that off right here and we can go from there. So now we can see how we are set up and we can see what we're facing. This is just the ES. Take a look at the Nasdaq. I mean, this is just, it's unbelievable what these look like after a month. And we talked about this, if you go back and look at October's video, we were just discussing it, not pontificating, but is this going to happen? Are they setting up cups and handles? And everyone was saying, oh, it's not deep enough. The market doesn't care what we think, right? So here we are setting up. And of course, this is all happening because of the macro driver. And that's what's really important about all this. We're going to spend a lot of time tonight just drilling into exactly what's going on out there. We have a cup and handle. We have a cup and handle here. This looks perfect. This is your monthly chart. I'm not overbought. You can see historically how long you can stay overbought once you're up here. Look at the Russell and look at how we move. And look at this base on the Russell. We were just talking about this the other day. And I was saying, I'm usually early and I keep waiting for this move in small caps because small caps are like a ship. Small caps turn a lot faster, right? It's a lot easier to turn that ship. So think about it this way. You have that quick ship. They're easy. They're nimble. Whereas if you're trying to turn something like this, it's going to take forever. And this really falls into the heart of why small caps are so important and why I think that that's where we're going to be in 24. I'm going to walk through the exact combination of metrics that make me think of why. And I've been saying this for a while. You're in the first, second inning. This looks like the mid 90s. There's a lot of similarities, more than I actually thought. There's a really good clip from JP Morgan's asset manager. Comment below if you know if I can use clips from Bloomberg in my YouTube videos. I don't know if I'm able to do that or not, and I really didn't want to do it in this one because it's packed with information. I clip out and I took a transcript and we're going to go through that, but I want to know if I'm able to do that or not. So if you have the answer to that, just put it down below. I would appreciate that. But again, regional bank, mega bank. Think of it that way. And that's why this moves. RTY is 15.9% regionals or regional financial service companies. Again, we were talking about this for some time, and it was absolutely maddening to me because we were buying TNA on this break and then it just undercut. And right for me, I got to get out of the way. If you're going to come up, pull back, I have to go. But we're seeing this pattern all over the place, and we should probably talk about it. We're going to go through some ideas of it, and later we're going to go through a UPST trade. Once you understand, identify patterns, not just day trading, swing trading, long-term trading, but that's what I do. Whether those patterns are macro, technical, fundamental, I just overlay them, right? Same soup reheated. But you see these wicks? Go look at a firm. Go look at LMND. Go look at UPST. You're going to see a lot of these names have very similar activity, and it all stems from this very particular pattern. But look at this candlestick pattern and how you're coming across. Look at this flag and how we couldn't move. And it was just absolutely maddening. And for the longest time, I thought I was right with just buying ARK. We bought ARK in the community. If you're trying to join the community, at the time that this video goes out for this week, it will be the end of this weekend. If you're on the wait list, you would have gotten a letter, and then it's closed till sometime in 2024. I don't know if I'm going to open it up right away in 24 or not. I might give it some time because we're getting the demand's getting a little bit overwhelming. But you'll get a letter if you are on the wait list. So here we are, and we're breaking out, and then we thought coin wasn't going to go, but I don't want to just get into all that yet. We're going to get into it in a minute after we start understanding the economic data, why the bond market's going to absolutely implode here, and what to do about it, what to look for there. But I thought this might be over. Got up here, pulls back, and then because you're looking at coin and going, well, that's it. The party's over, right? Party's over yesterday, 118. Party's not over. You're up 17 points from the bottom. The party is clearly not over, and here we go, and we're pushing. So ARK's not done. DPST is another one we own in the community, and we're doing exceptionally well with. But this is fascinating because you understand why these are moving, and you understand what. You understand the stool, and understanding that stool is half the battle. Here you are with regional banks. They're moving. Well, let's take a look at something. Okay, XLF's on fire, but look at KRE since June. It's outperforming it. And I thought that's where we were going, where we were just going to see the regionals and diversification, sectors coming out and sectors moving in the financials, in the IWM. And so we were looking at this, and you can see how this is basically almost 2-to-1 at that point. Remember, we're going to cover a lot of concepts that we used before in tonight's video. But if you're trying to figure out which names you should be in, we went through how to sort by relative strength. And this is a great way to just do it in the middle of the day. You drop a 1-minute chart, you turn them into lines, TradingView, any system that you want, and you can just really just look at them and boil it down very quickly on what's going on here and say, okay, this is the way that I want to play it. And would you want to be buying regionals today, or do you want to be buying JP Morgan? Well, we knew the answer to that because we did the due diligence and we know what you're supposed to be buying. So instead of looking at XLF, instead of getting excited that JP Morgan's up $1 and Goldman's moving, it makes more sense for us to start looking at the NYCBs of the world. And you're going to start seeing them having outsized moves in comparison. That's what you're trying to do. You're going to start looking at Key Bank. You're going to start seeing these names really start to move. But this is setting up to break out. Now, you start looking at names like Key Bank, and we're going to get right into the bond market here in a second. But I want to show you what's happening under the hood and where you need to go. And then we're going to tie it all together, and then we're going to go through some individual names. But there's a lot in here. Please comment on how much you're about to go through. There's a lot of data in here, a lot of similarities. This took a lot of time to put together tonight at the time of recording this. But comment below, and as always, I appreciate you sharing it. But look at these moves that you're starting to see in these names. This is exactly what you're looking for now. We take these kinds of moves, we see these gaps that are going on. We have to think about, well, why is this happening now? Why was RTY up 3% today and the Nasdaq 24 basis points and ES 52 basis points? Well, it all goes back to the 10-year. Now, we have this island reversal that was perfect here, and I always laugh when people say, don't chart yield. The people that are like real big bond traders say, you never chart yield, you chart price. If it moves, I will chart it. So here's your island reversal gap. If I overlay the simplest of indicators, indicators. I use a 12, a 22, and a 55. You should use what you're comfortable with. So you could see right through 450. Well, what's next here for us? Well, if we look at this weekly chart and just drop our line and drop our pin right there after you broke 432, you got a little ways to go down here at this point. Maybe you stop at that 410 level. It seems like that was a big issue for whatever reason. That's 4%. Obviously, that's going to be huge if you broke the 4%, which I think you're going to be doing by March, candidly. We have very large positions in the ETF. I'll walk through those very quickly here. But why is this accelerating? This is accelerating because of what's happening in Europe. So we went through a period in time where we didn't know if we were going to ever see a cut in 2024. And then that cut moved to July. Oh, it's going to be July when you're going to get a cut. And then it moved to, oh, it might be June. And then it went to maybe you're going to get a cut when? Well, maybe you're going to get a cut in March. That might happen, but we're not sure. It might be June, July. You might not even get a cut this year, they were telling us. Well, this year, this week, it happened. They came out and said, well, it might be Europe that cuts before the US. So the entire dynamic has changed, and that's why the market's dropping. Take a look at this. Now, in front of us, this is Fed Watch Tool, and here is the web address right up here, so you can get this yourself, and this is free. This is December 13th, which is 11 days away, which is the last meeting of the year 2023 of the Fed. What this will show you is now day one, which was yesterday, a week ago, and a month ago. So current chances of rates staying right where they are, 525, 550, right now is 97%. When we started the month, we were at 79%. This is going to get really interesting, at least I think. Now, the chances of a rate hike November 1st were 19.6%, and then we went to 2.7. All right, so we're just going to focus on the big guys for now. The month, we're going to not pay attention to the nuances. So this is pretty clear that anything that would happen outside the norm of them doing nothing would be surprising. Now, note the date, and this is January 31st. This is the first meeting of the year, 16.1%. There's a 16% chance now that they cut rates, 16% chance that they cut rates in the January meeting as of now. A month ago, it was 0.8%. A day ago, it was 4%. So I just want to show you the difference so that you understand this. 4% November 30th, December 1st, 16% chance of them cutting rates. In the past 3 days, the amount of data that has come out of Spain, Germany, and France, and I don't want to turn this into a macro bond allocation lesson, but we need to be aware of it. So we're going to have to get into a little bit of it here. And I want you to understand why we're going to get into it and why it's important at this particular time. And this is something that you really want to pay attention to, okay? This drop and what the heck happened in this period of time. Forget about just US data, because it's not just US data that's doing this. It's a conglomerate of data globally, and we need to understand this part of it. So 81.7% chance we stand pat, 16% chance they cut, 2% chance they raise rates. Get into March, and then we see 9.7% chance. Well, let's just roll this back so you understand what that means. That means that currently we are at, this is where we are right now, 525, 550, where it says current. There is a 34% chance that rates are where they are right now in March. So if people that are telling you that they're not going to cut rates in March are betting against people that are literally wagering billions of dollars right now. Literally, if you want to count the entire global bond market, trillions of dollars. So it is pretty clear right now with the data that has come out that they are going to cut rates in March. We'll explain why this is important in a bit, and it's going to tie back into 95, high productivity. We're going to get into it all. So stay with me, guys. All right, so a week ago, there was 0% chance that they would ever cut rates 50 basis points by then. 50 basis point cut we're looking at March. There's a 10% chance of a 50 basis point cut now. Day one, 1%. Today, 9.7, 41.5%, 55.4%. 55% chance that they cut rates in March. Let's take a look at May. Now, this is where you currently are. Okay? And what they're telling you is that this is a 25 basis point cut. This is a 75. Okay, so this is what you're dealing with already. This is the movement and the shift that you're saying. So the idea that things didn't just fall off a cliff over the past month and then the conglomerate of what happened this week is a gross understatement. Now, bad news has been good news, and bad news will become bad news again, but that's not going to affect us in the same way. And we're going to talk about that a little bit differently. Now, watch this. Now, the further you go out on this Fed tool, just so we get this, a year later, just so you can think about this, a year later, there is virtually no environment whatsoever where they have rates where they are. A matter of fact, if you were to take the two largest here, this is roughly 125 to 150 basis point cut, and this would be 100 basis point, roughly 100 basis point cut, right? So when you just look at it that way. So if you want to figure out which way rates are going, this is how they're betting. But let me show you the data on why they're leaning that way. Now, how did this avalanche of rate cuts and talk of rate cuts start? It started this week when we started seeing economic data come out. For example, the data that came out of Spain. You'd see inflation rate month over month. Preliminary, this is 3 o'clock on a Wednesday. And what you start to see is this was the previous. You start seeing things along the lines of this was the forecast and this was the actual. So this was your forecast and this is where you came in. This was previous. This was your forecast. This is where you came in. And you're seeing a pattern here. And it's very hard to miss this pattern, especially here when you start getting negative on the pattern and you can see your forecast and dropping. So what are we seeing here? Forget about retail sales being negative, but what are we seeing here? We're seeing that inflation is plummeting in Spain. Fast forward the same day on Wednesday, here we are at 8 o'clock, inflation rate year over year, preliminary, actual, previous, consensus, we were down. Forecast, inflation rate month over month was supposed to be negative, consensus, previous, negative. Harmonized inflation rate, 0.2, negative, substantially lower. It was all over the place. Then we roll into Thursday, and here we are again. GDP, negative. Inflation rate, month over month. France, negative. Rate, month over month, negative. Year over year, 3.8. We were looking for 4.1. So what we're seeing is we're seeing an implosion in Europe of CPI and PPI. Look at year over year, you're negative. Okay? Negative denotes that prices are coming down and that they are cheaper than they were a year ago. And that is exactly what's happening year over year to PPI in France. This led to the argument of not if they're going to cut, if Europe's going to cut. It became is Europe going to cut before the US cuts? Now, one of the things that we have to focus on is financial conditions. So up here, and I'm going to go back to this drawing tool, guys, for a little bit. I seem to like it a little bit better. I can point things out a little clearer and the circle doesn't get in the way. So I'm going to go back to this for a little bit. But the financial conditions, if you take a look right here, that's what FCI stands for. So we have financial conditions here. Great. What does that mean for you? And this one is just Goldman Sachs's, and this is from Bloomberg now, or a Bloomberg terminal. Please note that this is a monthly chart. And what I want you to focus on is what does it mean, first of all? So we did financial conditions about a month ago. I'm not going to go back and review it, but this is going to show you the monthly change. That's not rocket science. It's a monthly chart. All right. If financial conditions are currently tighter, meaning if they are going up, i.e. here, then that means it's harder to borrow money. Financial conditions overall are what? Tighter. If they are tighter or higher, your car payment's too much, things like that, right? You get it. Okay. Just a refresher. Any questions about that, comment below. Now, what happens when it comes down? Well, life gets a little easier. Okay, so life gets a little easier. You can see here during the recession, 02, 03, you can see right here. And then you have parts during the great financial crisis. And then we are here. What they are showing in their chart, and this is their FCI index, and the Fed Board of Governors, Chicago has one, St. Louis has one. A lot of different places will have different FCIs. I'm using this one because I like this one and I like the way it's calculated. I'm not going to get into it all. But what you are is looking at a monthly chart. You are looking at the fastest, and this measures the decline. So I am looking at the fastest decline on record in 40 years. And what people are having a hard time, why do you care about this? Because people are trying to have a hard time understanding how we've gone from stop worrying about rate hikes and now start worrying about rate cuts. And it's really very important to get this one concept down. If you take one concept away, we have gone from the following. We have gone, they are going to cut in July. Then it was, they are going to cut in June. Then they're going to cut in March. You had Germany, you had France, all come in on their CPIs negative, okay? Not positive, not above their CPIs, below their CPIs. Bear with my drawings. Where am I going with this? We're no longer even worried about March anymore. Now the concern is who's going to cut first, okay? Who is going to cut first? Is it going to be the US or is it going to be Europe? That's the argument now. It's not if there's going to be a cut by March, it's who's going to cut first. Now, picture if inflation picks up, this could all unwind and the cycle can complete itself once again. But that is the argument right now. So when people are looking at the market going, well, this isn't sustainable, we're too high. This is where you were right here, zeroed out. on financial conditions, and again, this one will look different if you're looking at one online. Most people will show one from Chicago or St. Louis. This is just Goldman's GS. You get it. So what is this telling us? Look at what right here, negative 0.93. What is that telling you? It's telling you every single thing that you need to know, that you're at 40-year lows, that the financial conditions out there are plummeting. Now, if you go out and take a look at cars, forget if you look from a year ago, 2 years ago, but go look at cars the past 30 days. Go look at how many have been sitting on the market. Go look at the price drops that are starting to happen on used cars. You're starting to see this, guys. You're starting to see it in rents. Whether you're seeing it in your area because you're in a metropolis or a metro area or you're in a hot area, you might not, but you're going to start seeing things getting weaker. And that's why certain sectors acted today the way that they did. And we need to talk about those sectors and why that can continue and why you could see inflows into beaten down sectors. In other words, this is good for certain sectors. It's actually great for certain sectors, and it's great for the bond market to an extent, but eventually bad news becomes bad news. But let me show you something else. And I want to point something out before I do. I've been saying on YouTube and for a period of time, even on Twitter, that I view this as we're in the mid-90s. And the reason that I keep saying that we're in the mid-90s again is not because I want to relive my glory days, right? I'm in my glory days, just kidding. So here we are. At least I made myself laugh again. Here we are, right? Mid-90s. Okay, well, what's going on right here? Well, that's interesting. Okay, so here's financial conditions right there. And I'm just going to leave that there for a second. And then we're right here. Actually, what we could do is let's just draw this across so you can see what I'm talking about. So you see your mark right there, right? And I want to show this. Now I'm thinking about it more than we get anywhere else. Okay, so where is the only time, that's a better way to show it is this. When is the only time that you've been here? And you already know the answer because now you know where I'm going with it. And I appreciate your comments about not having to edit this stuff. You have no idea how much more data I'm able to give you by not editing and just getting it out there. Look at that. Okay, so mid-90s. So when someone says, when you say to someone, well, this is like the earlier mid-90s, and they'll say, no, it's not. You're going to go, you got to watch Arete Trading's YouTube channel. So you see what's going on right there? Okay, and here we are again. And I want to show you this before I get to the next graph. So there's the financial conditions, and then you know from 93, 94, 95, and how this played out. Okay, so what do these two places have in common? We walked into the internet days, all right? So what happened during the internet? Okay, productivity went through the roof, right? So if you look at this, and you think that of that as productivity, put one back here, put that back, make it bigger. All right, good. And we think of that as productivity. And then what happened during that period of time to productivity? Productivity went up. Why did productivity? The internets, right? I know it's internet. So the internets, that's why we went up. Okay, what happened at the same time that was going on? They were cutting rates. Okay, when did they start cutting rates? You should know this by heart. I say it so many times. They started cutting in 95. Right here is where he started cutting rates. Greenspan's like, I might have done too much. I'm going to start cutting. What happened from 95 to 01? You had the single greatest creation of wealth that we've had in probably 50, 60 years. It was staggering how much wealth was created during this period of time. What do you have here? You're at a level where the financial FCI, Financial Conditions Index, is down. Okay, I follow that so far. And at the same time, we have a new technology that's out that everybody is dealing with. What is the new technology everyone's dealing with? I mean, if you don't get it by now, it's called AI, right? So you have AI at the same time this is happening. What does this mean for us? Well, that means that productivity of large corporations, okay, is going to go up at the same time that they are going to globally be cutting interest rates. Only this time, the drivers have more money. And we're going to get into that the drivers have more money in a second versus what happened here and what led to this. But first, we need to look at something else that's going to tie this to the mid-90s. Now, guys, I want to say something. This is my opinion. I value your opinion, and I'd love to hear it in the comments. This is not a video that's telling you, oh, hey, he's a day trader. He's telling you what's going to happen on Monday. Okay, I just showed you a 50-year chart. Okay, I'm not telling you what's going to happen on Tuesday. I'm telling you how you should be mapping out and looking at the world and then trying to understand what sectors are going to move. And we're going to get into all that. What sectors are going to move, how you need to look at this. But if we take a look at this, this is a clip, and this is the analyst. This is actually from a Goldman report, and this is a clip. And you know, it's funny because I had someone say something to me the other day about, you know, research analysts don't talk to traders. Okay, research analysts talk to traders all day long and tell them exactly what they're thinking. And they put out pieces of information so that they can tell their institutional clients. If they didn't do that, they wouldn't get order flow. Anyone that doesn't believe that is beyond delusional. So see this average right here, 530? Okay. This is basis points right here. You see that, right? And what is this? This is year. Basis points? All right, we get it? Okay. S&P 500 EPS yield gap. So we talked about S&P earnings yield. We talked about this about a month ago. I said we're going to start introducing some concepts. You can go back, find that video a little bit ago. But you should know what S&P earnings yield is. If you don't, Google it. For time's sake, we're not going to do it again. Real yield. Okay, so we went through this. Real 10-year, okay, yield, U.S. Treasuries. You should know what real U.S. year Treasuries are. Okay, you should know what that is because we went over it a month ago. If you don't, because you are just watching, first, welcome. Second, just Google it. I don't want to run through the whole thing. I don't want to keep going over the same concepts. I want to utilize those concepts, expand on those concepts so you understand how to use them and profit from them. I hope that makes sense. If this gets too deep, comment below and let me know. Let's get to it. So what do we have here? Okay, so we have earnings yield, fancy S&P in basis points and the year. And that's going over the average. Well, look what happened here. Okay, when did we break that 530 average? Oh, we broke that in 95. Oh, okay. When did we break it here? About a year ago, around 22. So what is this setting us up for? This is setting us up for a very similar situation that happened right here. The same exact situation. How do you think that this is going to look if they're cutting interest rates down and earnings are going up? If they're cutting interest rates down and earnings are going up, that's what you're going to get. This is where we're heading. Right? So you have to think about that and understand that that is what, like this particular one, despite my childlike handwriting all over it, this is from Goldman and this is what they're showing their institutional clients. Do with this what you want. Now, before we go any further, you're going to note today's trading, and this is what you could do with this information. I go, well, how do I utilize this information Monday, Tuesday? Understand that the hedge fund crowding index and how they use the hedge fund crowding index, more crowded, less crowded. All right, how are they using this index coming straight across? All right, this is real simple how they're using this. What they're saying is that, are you more crowded or less crowded in the same names that everybody's buying? You're the most crowded you've been since here. Well, that's bad, okay? Especially when you have days like today when they don't move. What did we see today? We saw rotation. We're going to talk now about that rotation and why it happened. Now, one of the things I am constantly doing is comparing NVDA to Cisco. And if you've been watching these videos, you've seen that for some time. I've been talking about how NVIDIA is going to power the AI revolution, very similar to what happened with Cisco. And what Cisco did, it did it through telecom equipment manufacturing, obviously, switches, routers, the whole 9 yards. I'm not going to bore you with it. And during this period of time, we had this enormous move. And quite frankly, this doesn't even do it justice when you look at where we were. This is going to show you pennies on the dollar here at roughly 10. And just to kind of put this into perspective, if I draw a line straight across and you see that $10, before you even got to that $10 range, and you just said, okay, well, where would this have gotten us? I mean, just look at that move. That shows you how many times this split. And what I always say to people is when they're like, oh, wow, 2020 was crazy. The internet was literally, if you go back by any metric, the internet during this period of time was 3x what you just went through in 2020. And people don't really get that. It's really hard to comprehend, but it really was that crazy. People were just going out there getting .coms, the website, and literally starting businesses and having money thrown at them. It was really very insane. Very similar to what you saw with NFTs and JPEGs if I had to find something that was that absolute insane. But you have this move up, and it was a pretty staggering one to say the least, and you start getting these huge bars over and over again where it just, every time you turned around, you were going up 20, 30% a month. It was crazy. And then, of course, it comes to the end. Interesting while we're here, how you see these patterns and how they still exist throughout time, right? Down, up, 1, 2, 3. If you're in the community, you know this pattern by heart now. So why do I think it's this? Because Cisco back then powered what was happening with the internet. It could not really exist without increasing the bandwidth, hosting, which was huge back then. They supported that. And AI does not really exist without NVIDIA. Now, I say this a lot, and then people will say, well, I don't view it that way. Well, the analyst that does view it that way is the head of equity portfolio management at JP Morgan. And I want to show you something. Now, for reasons that I'm not sure about, I don't want to put that video and copy that video. So in here, I'm showing you what it is and when this was done. So on 11/22, at the 55-minute mark, I would watch this video. It's right on Bloomberg surveillance. All right, I would go and watch this, 11/22, the 55-minute mark. I would go and watch this. But what I want to do is just point out a couple key things that the guy says. And this is just a service that I have that actually transcribes. I just transcribed it for everybody so they can say it and go from there. I could probably put a copy of this in one of the, subscribe to the newsletter if you're not in the free newsletter, link in description, and I will put a copy of this transcript just so you can see how this goes. This is Jack Caffrey's the guy's name, Equity Portfolio Management at JP Morgan Asset Management. Good morning. What do we see this market broaden into next year? Let's break it down into 3 steps. The holiday, obviously this is 11/22, has been really a good year. I think the context, what most people are putting forth is what to expect. Tax selling. We've been talking about tax selling here, and I can't stress enough, you're going to want to watch this 10-minute clip, go to that website or wherever. I would finish this video first, but put that on your list of things to do. To me, it's very enlightening what the guy has to say. And he just starts talking about the government kicking cans down the road. We've been saying that for 100 years. The election's an issue, blah, blah, blah. We all know that. But then you're going to have a continued tug of war between the earnings outlook and the multiple. What happens? The bond market becomes really important. Now, this was 11/22. And what's really timely is that at the time of recording this, it's December 1st. And this was a week ago. And he's telling you what needs to happen in order for not only this to continue, but for this rally to be something of substance. And I think that's really important. So it just continues with a little banter, but I want to just get to the heart of it. Single-digit returns for agents, certain years that we're all behind. How did you catch up? Trying to figure out because I'm behind this year. All right, trying to figure out that because I'm behind this year. Well, you got 3 minutes, so give us the answer we want now. Okay, I should have bought a lot more NVIDIA. He cracks a cheesy portfolio manager joke. Doesn't fit his mandate because he focuses on dividend growth. All right, if you look at strategy, earnings are supposed to be down this year. This is really important stuff. Just to get an understanding of the market and where you're at, and then understand why I think that this not only can continue, but why he thinks the same way that I do that it's related to what happened during the internet days. If you look at the strategy, earnings are supposed to be down this year. Remember that. We were supposed to have earnings down this year. They're up. That's just a fact. So that fits right into what? Our stool. Macro, fundamentals, and then technicals. It fits right into that fundamental stool, right? The earnings. Okay, and that is being driven by the macro, obviously. They wound up being up. Dividends are up, mid-single digits. You can find portfolios of stocks that are low double digits. Do you fault big tech because they don't pay big earnings, and so they crack another little joke, can't behave them for being rewarded, blah, blah, blah. More portfolio management humor. To the extent they have entirely almost 30% of the market to manage itself. From an earnings perspective, consistent cash flow for investors to those management teams. Do you know what they've done? I think you know dividends offer a real check on earnings. Real investors like them decide. Lisa, this is the one host. NVIDIA drowning in debt, 1.1%. So I want to be really clear about this. You have a company that's throwing off massive amounts of cash. Massive. And that's how much debt they have, 1.1%. Okay, this is a cash flow bonanza right now. At what point are we pricing in a potential continuation of the pace of acceleration of that cash bonanza into the future? How do you even game out what we're pricing in given the moonshots you've seen? NVIDIA today reminds me, and this is him speaking, NVIDIA today reminds me a lot of Cisco in the late 90s. Who else has said that? Some guy that has a YouTube channel. And that was our defining stock. If you traded in the 90s and you're watching this, you know that. So what Cisco was to the internet, the complete network world, everyone hung on what John Chambers says. Everyone is hanging on the words of this current CEO and founder of NVIDIA. It's the same exact thing, right? And again, he would always beat earnings no matter what they did. They always would beat earnings. Time after time, it only came down to when his customers ran out of money. Pay attention to these couple lines because this is why this can be even stronger than the internet as far as growth. Came down to when his customers ran out of money to keep buying his servers. That's what stopped them. When they ran out of money, when they couldn't borrow any more money to keep buying the servers. NVIDIA now sits in a particular position where they can sit there and look at the capital spending of Microsoft, of Amazon, of Alphabet, with some rework of chips, what China intends to do in AI, what countries in the Middle East seem to be doing in order to actually build up on their own AI equivalent. And you all come back, at what point does the investments that others are making start to actually become more challenging? You know, the difference now versus the 90s, or I have to admit there is a difference. The differences now versus the 90s, and I have to admit there is a difference, right? Key statement. I'm really glad I did this in transparency where we actually take the transcript and go through it. Cisco's customers were all debt financed. And so what the Fed wound up doing, draining liquidity. Did we have any other times in the market where the Fed was draining liquidity, right? When they injected 1.7 trillion in the market and then just did what? Sucked it out. Taking down the concerns of the flood of liquidity for Y2K. Remember that? Who remembers the ancient history very differently than the extreme power base of the very profitable cash flow generating companies, which is by far the most part, aren't being asked or pressed to return cash to their investors. Okay, so you have Microsoft, Amazon, and Alphabet that are not being asked to return their cash to investors. In some case, thanks to dual voting stock, they are not ever going to be pressed. This is a fascinating point. In other words, how long do the customers have open pocketbooks and plenty of cash, and their customers have big open pocketbooks and massive quantities of cash? So how much can you see the moonshot continuing in some of these names that we didn't appreciate? Perhaps the beginning of the year, well, I think Wall Street loves an easy story to understand. AI is conceptually really hard to understand, but if everyone wants to do it, everyone's going to keep spending. And certainly right now, the cost of capital is higher, but it's not, right, the cost of capital is higher, but for how long? It's not still all that burdensome against a longer term history of what money should cost. To the extent of these companies which are really driving that spending either have access to a blank check, if you're in China, effectively from the state financing or personal financing, and ultimately coming through. But when you look through, people are somewhat disappointed in NVIDIA. And this morning, this is when they came out with earnings, said, oh, okay, that's all you've done for me. One more piece that I want to go through here. They're talking about the cycle. When they say cycle, what they're referring to is the economic cycle. Expansion, contraction, we're going through contraction. And this is what he has to say. This is one of those trends that you can just see out beyond a recession a year, 2, 3, or 4, 5 years down the road. Necessarily have a cyclical feel, since we are looking right now at something that is a moonshot, very specific slice in history that has the dominant footprint. Now, when you understand all of this, this is just NVIDIA in a monthly chart. When you understand all that, when you understand where we are on the productivity scale, when you understand where we are on real earnings versus S&P earnings yield, and you look at the mid-90s, and you sit there and you watch the JP Morgan asset manager equity portfolio guy reiterate what we've been talking about all year long and saying, this is just like Cisco, except it's better, is essentially what the guy's saying. They have deep pockets. This is going to be recession-proof. They just have cash. Recession-proof to an extent. I'm paraphrasing before you drop it in the comments. So what do I think? I think we have to look at this, but that doesn't mean that you're not going to rotate into different sectors for periods of time and then come back to this. Because when you start to rebalance your portfolios, which these guys are going to have to do, meaning these guys, meaning institutional investors, because of yield, well, that's going to drive other parts of the market. And we're going to talk about that now. But this is a really important concept, and this is a very long-term concept. When NVIDIA drops $10 on Tuesday, don't think, oh, but you said this is a long-term concept, guys. I want you to get this, because I truly believe, and I've been saying this all year. Well, I've been saying it since about mid-year when they crushed, and I really started to understand the story. I think that this is going to be bigger. I think this particular story and understanding the nuances and who all the players are, I think this has the potential to actually be bigger in some cases than the internet. Let's take a look at how money moves. Now, one of the things I get a lot is, oh, I'm a day trader. I don't need to know about macroeconomics. I don't need to pay attention to it. I just want to trade stock. So I want to show you how you would utilize your knowledge of macroeconomics to actually day trade, and how you're going to find the best ideas by doing this. Not only are you going to know what time to look for in the market, but you're also going to be able to determine what names you should be trading that day. And it's going to be dependent upon what data comes out. And I'll explain. Here's the ES, and this is a really important concept. If you get this concept, you can actually I would watch this concept over again. And then you can use this going forward. All you have to do is go look at investing.com or Trading Economics when data is coming out, and then see how we respond to it. Now, here's the ES. So this is S&P. This is 1 minute. It's always up here exactly the date of filming this. And I spent a little time trying to back end or re-engineer the back end of this video, because I thought that this was an important concept and I didn't like the way I did it the first time. So just watch this and then let me know what you think of it. Comment below and please share this, because it's a really important concept. So here's the ES. What happened at 10 a.m.? Now, 10 a.m., we had ISM manufacturing. Everyone was excited to hear Powell. For some reason, I thought this was going to be 2 p.m., but he started with his statements at 11 a.m. So here we have ISM manufacturing. This was previous. This was a consensus. This was the forecast. So ISM manufacturing, which is obviously the manufacturing of our country, US, right here, okay? Here's the PMI of that. I want to get into some of these other numbers so that you're paying attention to it. ISM manufacturing new orders, see how they're upticking? ISM manufacturing prices, see how they're upticking? All right, so you have those pieces of data. You have Powell that's sitting right here. So all this data comes out. Even after this data, Powell still comes out with his, and nothing really changed. New orders to me are pretty interesting, because you're seeing what's going on in the future, hence new orders. ISM manufacturing prices, you can see how is pricing. Why is that important? Pricing is very important because it tells you what the prices are. So if the previous prices were here, which is 45.1, and 45.1, just so you understand how these numbers work, anything 45 is contraction. Actually, anything under 50 is contraction, but 45 is considered almost recessionary contraction. 50 is pretty much you're neutral. 55 or greater is panic. Things are way overheated. That's how these numbers should be judged. All right. So if you look at ISM manufacturing, so you're telling me PMI came in line, but prices are up, new orders are up, but manufacturing's in line. Well, if your manufacturing's in line, if you just think about it this way for a second, if your manufacturing's in line, but you're getting more new orders and your prices are higher than they were before, that's a good thing. That means you're making more money. But it also means something else, that if PMI is staying low, if manufacturing PMI is staying low, then that means that the economy is not getting overheated. Now, this is 10 o'clock, and look what the market did on this data. So the one thing that the market will do is it will have an initial reaction, and then it will have a follow-through reaction. The reason you get the initial reaction is because people will look at the headline numbers and then act. You'll know this from watching non-farm payrolls and then how the market acts later. You've seen it several times. Why is this important? Because you don't have an enormous amount of economists at your disposal as investment banks do. So you're going to look at a headline number, you're going to act. Undercuts that headline number. What I tell everybody to do when you have an important event is mark that important event off. It doesn't matter when it is. Here's that 10 a.m. doji, and then you can see what happens from that 10 a.m. doji, because you'll see this at 8:30, sometimes pops over, down, undercuts, tries again, doesn't make the lower low, comes up. Resistance becomes what? Support. All right, you're with me? Great. Now, let's understand, once this comes out, what else moved? Now, I'm going to put this in line form because it's just easier. So this is TNX. What happened to the bond market at 10 o'clock? It imploded. Everyone just bought the heck out of the 10-year. So the 10-year drops, ES spikes, and now here's the dollar. What's the dollar do during? They start selling the dollar at the same exact time. So now, how in the world is this supposed to help you with day trading? If you have an event, and that event, back in candles, if you have an event, and that event affects the market, and it affects interest rates, and you know that you have investments that are depressed, sectors that are depressed, what you want to do is you want to go in there and look at those sectors that are depressed and see how they are acting. For example, you take a look at XLRE and you just look at the most simplest of indicators. And I would suggest that if you're day trading and looking for opportunity, the easiest thing for you to do is to take all of these, take all these sectors, all the XL sectors or all the XLE, XLF, I think there's 11 of them, 12 of them. There's some others out there like the miners, and you throw them all into one sheet that's like a 5-minute, doesn't matter what index you use or what service you use, and you throw into something like this. And then you watch how you act at these events. Because what you are is what I am. You are the remora. They are the sharks. You are playing against the smartest, most disciplined people in the world. You might not know where the money's going to go, but when they put it to work, you're going to see where the money's going to go, whether it's this day, whether it's this day, it's not going to matter. You're always going to see that. So another little tip, we went over that a month ago. All right, so here we are at 10 o'clock, XLRE starts taking off. Well, if you're overlaying this with XLRE and you're overlaying this with, let's just say, XLK, and you're seeing the market, well, here's 10 o'clock. Get to that 10 o'clock. Okay, well, what moved? What didn't move? Okay, well, tech didn't move. Real estate moved. So if you were to look at this, and you can always just look at and cross-reference them this way. All right, so what you're looking at is XLRE in regards to XLK. You can always just do a little equation depending upon what system you use, and you look at the difference. It is a no-brainer on what you should be buying. If someone said, should I be buying real estate today or tech names? What name should I be trading? And by putting these all in, like one area. So for example, let me show you this. Let's just put that in for a moment. And what we'll do here is we'll take this out again. We'll just go XLRE, and we could just drop a couple others in that are interest rate sensitive like XBI. Let's drop some things in that are not interest rate sensitive, but like energy, and then we can just drop in maybe something a little more conservative like XLP, which is a defensive name. And you can just take a look and go, okay, well, let's drop this to a 1 because we want to see the exact moment that these move. I put them on December 1st. Is there any question what you should be playing? There's very little question. Now, why is this helpful? This is helpful because when I'm looking on, for example, Twitter, and someone's saying, hey, did you see what this guy posted about NVDA and they're buying NVDA? I very rarely look at that stuff unless someone in the community mentions it or something along those lines. Later in the day, maybe I'll read an article or something, or this guy's talking about this, or someone in our community is talking about, I think I'm going to buy Tesla on the dip. That's not what we're doing. What we're doing is we're utilizing this information. Now, we already had all the information. I'm going to clean this off. We already had all the information. Thought I was going to clean that off. There we go. What to expect because of what was going on in Europe. We already had all the information that interest rates and bonds were going to be bought, right? We've been talking about this for months. There's a reason, or a month. There's a reason why, especially for those that are in the community that are listening to this, there's a reason why we bought 20-year here. It's never going to see that again. You can cut this out, timestamp it, save it, throw it in my face a year later. We're never going to see that again. Same thing with HYG. You're not going to see these levels again. There's a reason we put these trades on, and they're just not going to go near it. So the first thing they do is they go after Utes, right? 2 Utes, my cousin Vinny. And so one of the things that we did early on when we saw that this was coming, we actually bought Southern Company down here, and you can For those that, again, that are in the community, you'll notice I don't even talk about it anymore. There's nothing to do with it. Just leave it alone because they're chasing yield. Once you chase the safest yield, you start looking for other yield, and you start looking for those yield-sensitive stocks. What does this have to do with day trading? Get back on point. Fair enough. Here's UPST. So when everybody is looking at what tech name they're going to buy, or should we be trading, like a lot of people in the room were looking at this going, oh, I got to trade SMCI today. They're doing the secondary. People don't understand. And I looked at it too. I was actually short and made money on it. I get it. Or I got to trade NVDA for the 400th time today because that's where all the money's going. And I get it. I do that too. But when you start understanding these nuances, you can start putting yourself, as I refer to it, like in a kill zone, right? Again, you're playing against the smartest, most disciplined people in the world. So one of the things that you're seeing, and one of the things you should pay attention to, is that I do pattern recognition. Remember in the beginning of this video, we talked about IWM and this particular pattern that you need to pay attention to. And we talk about these breakouts and these wicks and these wicks, and you'll see these patterns everywhere. So like here it is with a firm, and here's these wicks, and then whoop, it just starts taking off, right? All right, so here we are with UPST, and we know that UPST is in the driver space. And these patterns, when you see them, it doesn't matter what the 4 letters are or the 3 letters are, right? You'll start to see them everywhere. Wick, starts breaking out, and it, again, doesn't matter. It's completely wick, boop. So it doesn't matter. All right, so let's get back to the UPST. We know that we already know that we're interest rate sensitive. We already know that all the data that came out of Europe, because we do our homework, because we know we're playing against the smartest, most disciplined people in the world. So for us, this was a really simple trade for us to do UPST that day, and that became our day trading vehicle. And what we're doing is we're watching this right here, and I want to see how we act at that particular point. It's not rocket science trade, guys. We flip the higher high. People will say, oh, I don't like to buy the breakout. Okay, understand what market you're in, and then you decide if you want to buy the breakout. You want to start, if you want to play the same game you played in October, where you're shorting into resistance, you might as well write a check to St. Jude, because the game's completely changed again. All right, so here you are, right here. You see that level? Fights. What are you doing? Eating up supply. So that when it pushes, you have something. So not only are you buying into this, but look at the time that this is acting. All right, so 9:45, you start seeing a push, 9:52, 55, 56. Look at when it starts moving. What came out at that time, okay? UPST deals with loans. They are an interest rate sensitive stock. Okay, this became a very simple trade. Let me show you. So this is from the community. I'm just going to show it all here because I don't have time to cut this all out. I've got way too much going on. Here's 950, UPST, watch. Bought here, 28.15, 954 is when we bought it, okay? We were in a NVIDIA trade, and what I was saying, because that was not moving, and now we were going interest rate sensitive. If you want to get out, just get out of the way. And then I said yay, because we bought a bunch of coin and we were killing it in the trade. But at least I made myself laugh. But with UPST, watch 27.17. And then in here, I think I even say it, where I simply tell the room, like, look, I'm going to pull something out when it gets up like $1 or $2, but that I was in no hurry. And I was in no hurry to sell the stock. We've done exceptionally well with the trade. It is what it is. Now, if I didn't understand interest rates and I didn't understand how data was going to affect the market, and I didn't understand all the nuances, I would not have picked UPST. I would have been like other people that were like, I'm going to trade NVIDIA all day. All right, and how did that go for them? So instead of trading NVIDIA, I went and looked for other interest rate sensitive ideas. Now, some of these we were in from the day before, but it's not rocket science that at 10 o'clock, okay, if you look at these 10 o'clock levels, that all these REITs that are trading at a discount to book value exploded. That's not rocket science that this all happened here and that you're making $3 or $4 or 5% REITs. And the reason that you would know this, there's another one that we bought it the previous day as well. But once you start understanding this, you could start putting yourself into situations where you have more edge. So you're always fighting for inches. Okay, and you're always trying to get ahead of the next guy. And if you think it's not a zero-sum game, you're wrong. It is. Right? Someone's going to win, someone's going to lose. You have to decide who it is. Right? Is it going to be you, or is it going to be the other guy? So you can't think that it's just going to be rosy and everyone's going to win. It doesn't work that way. But if you take a look at these names like VNO, and you're not looking at how these REITs are acting, and you're not paying attention to this, if you're not looking at names like IMGN and understanding that there's an inordinate amount of cash out there, that is going to have to put money to work. You have more money, and I'll cover it this week if you want me to. You have more money and more dry powder in private equity than you've ever had in this country, ever in history. They're going to have to finance deals, or they're going to have to give the money back. I've talked about this. If you want me to get more into it, I can. So this is what you're saying. So meanwhile, and I'm guilty of it too. Let's be blunt. Tesla. I actually am long Tesla, and on top of being long Tesla, I had calls on Friday, and the calls didn't work. It is what it is. On to the next trade. Not everything you're doing is going to work. I thought it might move on the Cybertruck news. it didn't really go the way that I wanted it to. But that allowed me, when that didn't work, and this goes back to ego and things along those lines. And I actually want to write a book on this topic. But like, I can either say that I'm right and the market's wrong and they don't understand the Cybertruck. And by the way, I think the Cybertruck's hideous, but I thought it would get enough of a push off. So when it doesn't get that push off, and then people realize that it's not going to do what they want it to do, you have a decision to make. Do I stay with my trade? Do I convince myself that I'm right and the market's wrong? Or do I go out there and find another spot and make money? And what I chose to do was go out there, and in the room, we went out there and I posted, I think we had 28 trades on. I have like 28, I have so many swing trades on right now, it's absolutely insane. And that tells me how healthy the market is in the room. So I didn't really even want to put more on. But that told me, hey, you got to go take a look at RIVN. So there's another trade that I did, and I didn't even want to put it out as an alert because we had so many other things that were working. So what we're seeing is we're seeing rotation. We're seeing rotation in the small cap names. I think it is absolutely glaring at this point. We just talked about this, right? Who benefits the most? And so names like DPST that we bought in the community, these kinds of names, they're just beginning. And I'm going to save everybody a lot of time here. They are just beginning. And if you go back and you start looking at this data, you're going to be able to get in front of this. If you can just spend some time understanding macro and just the pieces. You don't have to become an economist, but understanding that, dollar down, equities up, that kind of stuff. These are your data points this week on what's coming out. Okay. It's going to put you in front of people, and it's definitely going to put you in front of the pack. One of the craziest things that I've seen in the market, and for those that know me, I'm in my late 40s. One of the things that gets me about the market is I never had this opportunity that the newer guys have, where you have so much information at your fingertips. It's just so much information. Look at PANW. Just looks like an absolute monster, doesn't it? You have so much information at your fingertips, but no one's going deep anymore to learn anything. Everyone's going broad, the clickbait. Oh, I like this name. I like that name. You should be looking at this. Look at this moving average. That's great. I trade off of all that stuff, all the technical analysis. I trade off of all of it. Okay, I do it all day long. You can, every hour in the beginning of the day, I'm live trading, so people can actually watch exactly what I'm doing when I'm doing it, right? That's not the point. The point is when you understand the nuances of the market, you can start moving. Everyone out there, guys or girls, you have access to more information than you've ever had before. It used to be an old boys club, legit old boys club. Like, that's the way it truly was, just like you've seen in the movies. Now you can go out there and you can go get your conference call. You can go listen to the earnings report. I can't tell you how much money that you can make if you understand these earnings reports and why crowd is going up, why you would understand why that was the one to look at after you watched Workday's report. When you understand those connections, you can get ahead of it. When you understand this kind of fundamental stuff, you can really run. Look at this one that we're killing it in, and no one's even talking about this name. Whatever you think of the company, I could really care a lot, right? It's 4 letters and 4 numbers. But if you start looking at like Victoria's Secret and you start understanding that this guy, whether you love him or hate him, I don't really care. But when you start seeing these kinds of names break out and you understand why they're moving, because he's taking the helm again and he's one of the best branding experts in the world, and then they start coming out and revamping and telling you their strategy, that's why this is moving up the way that, right? So understanding that fundamental story, and this is all at your fingertips. You can understand all this, right? You can drill into this. You can utilize what you're learning in these videos and then implement it yourself. That's it.